Right, good morning, and everyone, as we head into another day of trading on Tuesday, the 5th of March. We'll have a flick across markets and see what is going on, what's up, what's down, on a pretty negative start to the day. Negative start to the day due to China's government slightly underwhelming in terms of the start to their week-long annual session of Parliament. If I just click into this article, and you can just see in here, the Chinese government retained last year's target for economic growth of around 5%, which is fine, and announced plans to run a budget deficit of 3% of economic output, down from a revised 3.8% last year. So that's kind of one negative in there. If they're going to run less of a budget deficit, there's less money for spending on infrastructure and just in terms of stimulus measures for the economy. It also unveiled plans to issue $139 billion or 1 trillion yuan in special ultra long-term treasury bonds, which are not included in the budget. So one positive for kind of long-term economic growth, one negative for long-term economic growth. It's like a football match where one team goes 1-0 up, the other equalises, and then you kind of end up 1-1. But some market participants, believing that there's kind of some state-backed buying of some exchange-traded funds keeps Chinese mainland stocks propped up. Blue chip companies in China still okay. You'll see that when we go around to the grid now in a minute, but certainly the Hang Seng's down nearly 3%, and stocks across the board are lower, which is not really what we were hoping for in yesterday's session. But if you watched yesterday's video, we were hoping for some measures from China in order to boost stock markets across the board, which unfortunately we haven't quite got in the overnight session. Apart from that, really the only thing we got to go off again is apart from that is not the Bank of Japan, is inflation out of China. Kind of further reaffirms the stance that we are likely to get some form of interest rate hike from Japan at some point, albeit at 2.5%. It's not exactly massively over. Markets just say it's a bit higher than 2%, so they kind of need to raise it at some point. But it's not like it came in 5 or something like that, where it's an absolute necessity. So it's not like it brings it forward massively. It does still keep a rate hike on the cards for March and their meetings beyond. But we'll have to see if we get that at the next meeting or not, as we're not quite sure on that. For now, we can see across the board negativity. You can see the US equity futures lower, European equity futures lower, Asia Pacific equities lower, apart from the CSI 300, which is Chinese mainland stocks. You can see commodities across the board lower. Even Bitcoin down, Bitcoin slightly lower. I mean, it got up to kind of 68,500, kind of within spitting distance of all-time highs in yesterday's session. So it'll be interesting to see if it is able to breach it at some point over the course of today. But bonds being purchased and yields down, which is your standard risk-off play. Your US dollars higher, Japanese yen higher, with your Aussie, Kiwi and CAD all lower. CAD only up against the Kiwi and the Aussie, the Kiwi only up against the Aussie down across the board, in line with stocks, bonds up, yields down, dollar up. Classic risk-off trading across the board. It's not like there's a massacre though across the board. You can just see all these assets lower and these number of assets here higher, and that is exactly how it will work by a textbook in terms of risk-off trading. Does that mean it continues into the rest of the day? We'll have to see. Services PMI at 3 o'clock will be a focus. We'll keep an eye on that. We'll get a consensus of 53. Kind of some economic data out over the course of this morning, but these are all final prints from the PMIs, final prints from GDP. Again, is that likely to really impact markets too much? The flash estimates are a lot more likely to shake up markets than the final figures. So final figures, they're kind of the second or third estimate on a lot of these prints. So services PMI will be the main focus of attention today. But you come across the board, you can have a look at equities across the board lower to begin the session. You can see the S&P, Dow Jones just all over the place. We'll forget about that. But the S&P, the Nasdaq and the Russell all lower back end of yesterday and into this morning. The DAX, the Euro stocks all lower. Hang Seng lower. The FTSE as well, that I was looking at a bit earlier, getting whacked. You can see that in this morning's session so far. I mean, it's a bit of an interesting one before European Open, but anyways, the FTSE kind of does its own thing from time to time. US dollars, bit of US dollar strength, and I say US dollar strength, but certainly your Aussie and Kiwi lower. But that's more of an Aussie and Kiwi move. Euro kind of grinding lower, sterling grinding lower, dollar yen kind of all over the place. That's to be expected. Dollar Swiss kind of grinding higher, dollar CAD grinding higher. Dollar CAD grinding higher with oil then pushing lower. I mean, you would have expected oil to push higher, which we did get initially in yesterday's kind of markets opened up for kind of cash trading or pit trading hours in oil when it picked up in volatility. I was thinking markets would start to push higher in terms of oil, but kind of 3 o'clock it kind of turned around and got whacked a bit. So it's back at these lows. I still do think it's worth a buy though. You're still technically in your uptrend, just a bit of a pullback. I think buying the dip on oil probably not a bad idea, but we've been wrong so far this week. We were hoping for a bit of US dollar weakness, we were hoping for a bit of equity strength. That's not what's played out so far. I still stick to that kind of bias though, just a bit of negativity around China. Okay, it's caused a bit of negativity in markets this morning, but negativity in China over the last 2 or 3 years hasn't really slowed markets down. So I'd probably still err on the side of dips to be bought back into on equities, oil. I mean, kind of looking at the US dollar, I still did think it looked a bit vulnerable compared to where it was. I mean, certainly your Aussie and your euro and your sterling aren't exactly showing signs of kind of material weakness, so we'll keep an eye on that. But again, I don't think really much changes from a US and Europe point of view. Obviously, China has caused a bit of negativity in markets, but we haven't even started the European session yet. So cross that bridge when it comes to it in a bit. But services PMI later on, main focus of attention. But for now, I still can't imagine global markets turn around just off the back of China disappointing, as they have disappointed many times over the last number of years.